We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Christopher Aaron, founder of iGold Advisors and senior editor for Gold Eagle Investment Portal. Thanks for joining me today, Christopher.
Tom, thank you very much for having me.
It's great to finally connect with you. So, being a former counterterrorism officer for the CIA and Department of Defense, what got you interested in gold, and where did you get your anti-fiat education?
I would say sort of my development more as a person kind of led me in this way. I volunteered to join an agency when I was done with college, which was called the NGA, which is the National Geospatial Intelligence Agency. And they focus on mapping, satellite imagery, that sort of thing. And when I was with them in Washington, D.C., 2005, 2006, there was an internal opening at the CIA. So I was able to spend about a year and a half working there. And I worked on the drone program, the Predator drone program, deployed with CIA. Then I did another deployment with a private contractor in 2009. And so we were creating maps for the military, for the decision makers, real-time mapping so that the decision makers knew how to execute their strikes in the campaign of the wars in Afghanistan and Iraq. And at some point there along the way, I would say, if we go back, actually, it was in the similar time period in Washington, D.C., 2005 is when I remember, and I was just 2 years out of college then. I remember going into my office with other, let's be honest, entry-level government employees at the time. You're barely making enough money to split, a place to rent with 3 roommates at the time. And I remember my fellow colleagues being obsessed in 2005 with the idea of buying real estate, that if one could just buy a house in the Metro Washington, D.C. area, 2005, 2006, if you could just buy a house, and they would have these eyes, and all we have to do is buy a house, and then you'll be rich 3 years later. And I just remember thinking, something's wrong with that. If everyone is moving in one direction and obsessed with one belief, is there not at least a reason for me to take a step back and consider the opposite viewpoint? So I would say simultaneously as I was participating in the military program, I was educating myself on the state of world economics. You start studying the housing bubble, what led to the subprime crisis, which led to the global financial crisis in 2008. All these things are related. It eventually leads one to a study of the central bank system, the Federal Reserve, which eventually leads one to the study of gold. It's just sort of the natural progression, I think, for most investors who are willing to step outside the box of the mainstream paradigm. And so, I arrived at that point in 2007. And then simultaneously, I was still employed by the government and the defense world. And so I was doing one more deployment to Afghanistan in 2009. And while I was there, it's just like all the pieces came together. I realized that it's not just the financial system, where one has to think independently, but it was really the political, and military paradigm in which one needs to think independently. And it just led me to say, like I said, I spent a year in Afghanistan, in Kandahar, Bagram, Kaust, a few of these areas in southern and eastern Afghanistan. I also spent time in Iraq. And I observed with my own eyes, this is the takeaway. You observe stuff with your own eyes, whether it's people being obsessed with the housing bubble in 2005, 2006, or whether it's the failure of the policy of dropping bombs on people in a foreign country to try to change their hearts and their minds. If the goal is to try to stop terrorism, which is a goal I believe in because I'm a patriot and I love freedom and I love the United States and all of America for that matter, including Canadians. I love what we stand for on one level, but what I observed with my own eyes is that the policy of dropping bombs on people to try to change their way of living on the other side of the planet, it simply doesn't work. It doesn't work both from a practical standpoint. We were losing control of parts of Afghanistan. Between the first deployment I did in 2006 to the second deployment in 2009, we lost control of vast areas of Afghanistan, including the entire Kandahar region. It's like, the entire southern third of the country was basically lost to us between those 3 years. So it wasn't working practically speaking, and it also wasn't working from a humanitarian standpoint. And that essentially when I left the government world in 2009, I had to figure out something else to do that I felt would be both of use to the world and also in some way try to do something to repair my karma, to do something at least where I was attempting to be of benefit to people as opposed to blowing people up on the other side of the planet, if I may be so blunt. So, that's what led me into the financial world. I had been studying it the entire time that I was overseas. I'd been investing in gold and the precious metals myself starting in 2007. And then, you fast forward to 2015 and I said, this is the right time to start publishing some research, got involved with Gold Eagle and a few other channels. And so here we are.
Yes, it's interesting, Christopher, as you bring up this really, form of independent thinking that eventually led you to gold and to where you are today. I find that really interesting. And it seems to be a theme that, I don't know, you tell me if you find it common amongst other, let's say, gold investors that you know.
Yeah, I think that's a really good point. Independent. If you've arrived at the precious metals world, here's the message for gold, silver investors, even cryptocurrency investors, I would say, to some extent, although I'm not as passionate about cryptos as I am about the hard monetary assets. But if you've arrived at these points, which necessitates that you have stepped outside of the box of the mainstream financial world, the mainstream news world, you're at least thinking quite independently if you've arrived at these points. The message that I would like to give to people is that there are other important realms to think independently about. We could talk about health, extremely important. We could talk about, politics and events happening around the world. One's philosophy on life. I think all of these things are intrinsically related. So the financial side of things, and then these other realms. I feel like it's very important for people to be at least open to thinking independently on all these things.
Yeah, it kind of brings to mind a quote that a previous guest brought up, Christopher, was that gold and silver are a window to understanding the world.
It really is. I mean, and everyone here probably knows what I'm talking about, but they can remember back in their own lives when you have that moment where you have that aha moment where it's like, oh wow, and then you're like, okay, now once you understand gold and the way it fits in the international monetary system and then the functioning of the central banks, you have that aha moment, and you can never go back. That's not to say you have to put all of your assets into gold, or that has to be the only thing that you're investing in. But once you understand that as a cornerstone, the world just opens up. And I would say it's challenging because then you have to be a little bit. I mean, sometimes independent thinking requires being isolated to some extent. You might not be able to talk about this kind of stuff with all your friends and family from your previous versions of your life. But that's why I think it's great that we're here and we can talk about these kinds of things with people who understand. And look, we don't have to agree on every single point within these sub themes, but the fact that we're here and able to talk about these things, I think, is really great.
Yeah, I totally agree. So as we're talking about gold and silver and crypto, you call these as kind of as a class anti-fiat assets. And you recently made a video saying that we're likely to see a rotation out of some crypto assets and into gold and gold miners. So can you tell us more about why you see that change happening?
Yeah, I've been watching especially the relationship between the most speculative end of the precious metals world, which I would have to call the silver mining complex. If you think about the precious metals as a spectrum from safest, let's call it least reward and least risk. You're talking physical gold. And you move down that food chain to a little bit more risk, a little bit more reward. You're talking physical silver. Then you start to get into some of the large cap gold miners, maybe the streamers, large cap gold miners, mid-tier gold miners, junior gold miners, exploration gold miners, and then same thing on the silver side. The most speculative end of that entire spectrum is the junior silver miners or the exploration silver miners. And I've noticed a very distinct relationship over the last few years when the cryptocurrencies are having these parabolic runs, these parabolic moves higher, like we're seeing right now in Bitcoin, and it looks like Bitcoin may be closer to the end of that run. We'll see here, but Ethereum for sure, and some of these other coins, Dogecoin, and some of the more altcoins. There's a very distinct relationship where when they're having these parabolic runs, you see the speculative bid in the precious metals complex basically absent. And the only way that I can rationalize that, and specifically what I'm talking about with that, is you'll see the junior silver miners basically not getting a bid whatsoever, even when the price of silver itself is higher. And that's the speculative anti-fiat bid. That's the investor who understands all the problems that we're talking about, with fiat currency, with the problems with the military industrial complex, unwinnable wars continuing forever, massive debt loads around the world, especially in the United States. And, they understand all of these problems. So it's like we agree on all this stuff fundamentally, but they're choosing to express their vote against that system by cryptocurrencies instead of the precious metals complex. But that said, their vote is not, these are not the investors that would be going into physical gold. They would be going into the more speculative, and I don't use that word with a negative connotation. We're all speculators to some extent. To be a speculator means you're sticking your neck out there and you're saying, I have a belief which is different from the mainstream, and I'm going to try to express that belief by how I allocate capital. I think it's admirable. But those investors are expressing that in cryptos, not in the more speculative end of the PM sector, which would be the junior silver miners. And I think when the next correction happens in the crypto markets, you're going to see especially some of the more leveraged junior companies really start to outperform.
Interesting. So you were pointing out some leading signs that gold was headed higher in recent weeks, and I'd like to kind of get your take on what some of those were and how did you come to find them significant? Maybe take your example of looking at Wheaton Precious Metals as an example.
Yeah, Wheaton Precious Metals. Let me pull up my chart there for 1 second. Wheaton Precious Metals, for full disclosure, is a stock that I do not own right now, but I have owned in the past. It has a special place in my heart, you could say, but especially back to when it was called Silver Wheaton, going back into the last decade. And Silver Wheaton, as it was a pure silver streamer at the time, I noticed in my quasi-obsessive nature of studying the markets on a day-to-day basis, I noticed back in late 2009, early 2010, that silver Wheaton, and you could go back onto the long-term charts here. If you pull up the long-term chart of WPM, you know, if you go back to that chart from 2010, you will see that Wheaton Precious Metals had broken above its 2008 peak in May of 2010. This was a pure silver streamer at the time. All their profits were derived from silver. They had very little exposure to gold. Yet they were making clear new highs in 2010, May of 2010, which was a couple of months before silver itself really had that breakout above that $20 mark, the previous high from 2008, $21. It was several months before. And I remember saying to myself back in 2010, I mean, what's going on here? If the sum of silver Wheaton investors are bidding up this silver only stock above a previous all-time high, you know, what are they doing? And so at that point, I made a few leveraged investments in the silver market, saying maybe the investors in silver Wheaton are correct in foretelling where the price of silver is actually going to move. You know, so I think I bought a few calls at the time, and I increased my exposure into some of the more undervalued silver miners that had not yet broken out to new all-time highs. Or some of them, to be frank, back in 2010 were still bumping along their crash of 2008 lows. It turns out that that signal was correct. Wheaton Precious Metals, or silver Wheaton at the time, was about 3 or 4 months ahead of the silver price itself, breaking out above 20, and then it moved to 50 over the course of the next year. And so I started to follow these leading signals, especially in some of the bellwether stocks, as ways to say, hey, you know, maybe it's hard to sometimes accept this kind of idea, but maybe the sum of investors in a bellwether stock are actually smarter than the commodity investors itself, or maybe they actually lead the commodity itself. They know ahead of time as a sum what is going to happen better than the commodity itself knows, or the investor in those commodities knows. So what we saw, just to fast forward to today, you know, or let's say the last year or so, what we noticed going back a couple weeks ago was a clear breakout in what is now called Wheaton Precious Metals. So it's no longer purely a silver streamer, but they do have dual gold and silver exposure. And again, to state, I don't own the stock, so I don't care if you buy it or sell it. But what I do is I watch these stocks as a leading indicator, and especially the bellwethers like Wheaton Precious Metals, you know, perhaps a couple of the other streamers, and then, you know, the GDX as representative of the entire large cap spectrum. I watched these stocks, and what we saw back in just at the very beginning of April 2nd, was a clear break in WPM above the corrective structure that had defined the downward move from the August peak, which corresponded with the peak in gold, the new all-time high at $2,074. You saw a break in that downward structure at the very beginning of April, just a month ago. And I was saying, you know, I mean, what are the sum of investors thinking if WPM is breaking its 8-month downward structure here? It looks like they're anticipating that the metals themselves are going to bottom from that correction, which began last August. And it really looks, you know, even though we're seeing a pullback in gold today, I would like to see gold hold above the 1790 to 1800 level, let's say over the next week or two. As long as we get that, you know, and of course we have to say, as in the markets, as in everything in life, there's no signal that's 100% perfect. So you should never align all of your capital with any one signal. But what I'm saying is, on a highest probability basis, when you see these bellwether stocks breaking clear corrective structures, there's a lot of money there that's saying it looks like the lows are in for the metals.
So as we're talking about these drivers for the price of gold, Christopher, do you watch the real yields or the dollar as an indicator for where the metals are headed as well?
I don't follow real yields on a day-to-day basis, only because I've never seen a clear study. I've seen short-term studies on the correlation between negative real yields and gold moving higher. But I've never seen a good long-term study on that shows that to me with enough conviction. I actually follow nominal interest rates closer. I think if you look at nominal interest rates from the 70s, the correlation between nominal interest rates and gold was extremely tight correlation there. So it's almost like I see no need to go to another derivative of the nominal. I say just use the real interest rates that are printed. But I do follow the dollar, quite closely. And again, this is not to say that any one signal is going to be 100% perfect. But when you're talking about the international world reserve currency, at least dating back, I mean, it's almost 100 years now. It's, we're talking Bretton Woods era, post World War II. Okay, so we're at 80 years now in the reign of the dollar. I do follow the dollar very closely, yeah. And if we can just pull up this dollar chart for a second, I would say that when you look at the structure of the advance, going back to the 2008 low in the dollar, when it hit that 71 level, and then you had the panic into the dollar in the crisis of 2008. And then you kind of look, the dollar basically gave back most of those gains. You had kind of like a functional double bottom, let's call it between 71 and 72 on the dollar from 2008 to 2011. And then you start this rising channel, really clearly defined rising channel. And by the way, this is the kind of work that I did for the military leaders in Afghanistan and Iraq. It was trying to take a lot of data and presenting it in a way that is, hey, what's the takeaway? We've got 5 minutes to talk about this target. What do I need to know? We're sending troops in, or we're not sending troops in, or, potentially something even more serious. What do I need to know? And so the takeaway on the dollar, what do you need to know? You had a 12-year rising structure for the dollar from the double lows of 2008, 2011. Very clear to see. And then just late last year, you had a decisive breakdown of that structure in the rising channel of the dollar, shown in the red call out. Then you bump down to 89, which is basically a decade-long support channel shown in black, the black double line. You get that low. We were expecting that low in our premium service. We were saying to people, hey, at 89, this is not the time to short the dollar. You got a major low back from 2018 there, corresponding with those highs in 2008 and in 2010. So not the time to short the dollar right now, but perhaps after one more bounce, it's time to really be planning your exit strategy from dollars here. We had a retest. Retest is where the market comes back up to a former support structure, and then this retest failed, which is exactly what we thought it would do. Now, I'm not guaranteeing that the dollar declines this week or next week, but from a highest probability basis, when you see a 12-year rising structure that's broken and then a retest that fails, the next logical point for the dollar, this could still be 6 to 12 months out, depending on how much this bounce wants to consolidate here. But the next logical step for the dollar is to break that double black line at that 88.5 to 89 region. And from there, there's a modicum of support for the dollar in the 80 region. But when you break a multi-decade top, then after that, the message is the dollar is going back to all-time lows. And I would say that I think we are, anywhere from 3 to 5 years from seeing the dollar once again retreat toward those lows of 2008 and 2011. And that is going to provide a major tailwind in the investment thesis for anything that is priced in dollars. As the dollar is losing value, most tangible commodities are going to rise in value. And then I think the precious metals outperform in that period of time. Not every day, not every week. Here, and so some people get frustrated over the short run, which is understandable, but that's why we like to look at these long-term charts. You got a decade-long structure here it's breaking as we're speaking. And this looks pretty good from the standpoint of, needing to protect oneself, I would say, is the other thing. If you're heavily exposed to dollars, either in a retirement account or a pension fund or something of that sort, this is not a signal to panic and have to, sell every dollar you own. But this is a signal to say, hey, what's the prudent amount that an investor should be diversified into things that cannot get debased?
So the euro is also confirming this movement right now. Is that correct?
Yeah, the euro is breaking out from a downward structure from the recent high from last January. I don't think we have that chart to talk about, but bigger picture on the euro is the entire structure. The euro peaked out in 2008 above 160 to the dollar. That entire structure from 2008 down to the recent low, that entire structure, despite all the problems in the euro, has broken upward in favor of the euro. And so when you see a currency breaking a 12-year downward structure, even amidst all the horrible news coming out of the European Union, it's telling you that that thing is bottoming. So euro is bottoming and the dollar is topping here is our model. And I think we have the evidence to show it.
Excellent, Christopher. Let's move on to your other chart here. Canadian Ventures Exchange 99 to present and CRB Commodity Index 99 to present as well.
Yeah, and so if you think about this from the opposite standpoint of what we just looked at with the dollar, we just talked about the dollar bottoming in 2008. And Tom, could you actually scroll down to the CRB first?
Yep.
Great. So if you think about the dollar bottoming in 2008, look at where the CRB topped, 2008. And for people who are new to studying this, the CRB is an average of 19 different commodities, including precious metals, industrial metals, energy complex, agricultural complex. Look at where the CRB topped, right? And then it had a 12-year, and here's one of those things that I really like. There's, like I said, I generally stay away from all or nothing statements. Even when I say it looks like gold has bottomed here, it's never 100%. Mm-hmm. Excuse me, but there are certain things we can say with certainty, which is that the sum of the commodity complex is not going to go to zero. And the low that we saw there on the coronavirus panic down to 100 on that index was the lowest for the commodity complex in about 40 years. So when you see something that has declined by 80% and that cannot go to zero, that's a pretty good place to be looking at it from a contrarian standpoint. And then the other thing that we see was this terminal wedge structure shown in the magenta, which is a pattern, a chart pattern. And all these patterns do is they show us these are the sum of human beings investing in an asset class. Just like we could study the sum of where human beings drive around by looking at a map of car traffic or foot traffic in New York City or Calgary. We can do the same thing with the markets. And a terminal wedge, this pattern where you see the highs coming down at a very steep slope, but you see the lows coming down at a lesser slope, that's a bottoming pattern. You put 2 and 2 together and you arrive at a significant bottom in the entire commodity complex. corresponding with a significant top in the dollar. And then if we look up, if we go up to the Canadian venture, I mean, it's the same pattern, and it should make sense. You know, the Canadian venture this is an index of the sum of the mostly development and junior stage resource companies. I mean, the Canadian venture, 60% of the Canadian venture index is made up of resource companies. And it's the same pattern. You know, you have that high so the high occurred in 2007 as opposed to 2008. It's like the companies were leading the metal. You know, we talked about that with Wheaton Precious Metals on the upside, but the venture exchange was topping out before the CRB topped out. And then you got a 12-year decline. You have a terminal wedge that broke out and made one final nominal low in 2020. So if I'm an investor right now, which I am, and this is what I'm doing with my money, it's what I'm doing with clients' money, we are looking at the sum of the commodity complex and the companies that are engaged in developing those commodities and saying, you have what is most likely a multi-decade low that is setting up here. Again, for an asset class that can't go to zero, that had fallen by 80%, and now the inverse of that asset class is topping, and you're getting a bottoming structure. So these things, you know, it's not to say that the CRB is going to shoot back to 3,400 within the next year. And even within a bottoming structure, there can be 30 to 40% corrections every 1 to 3 years. So you have to have a risk tolerance for this. But if you got 5 or 10 years ahead of you now, and you're accumulating quality commodities or quality commodity development stage companies, I think this is a life-changing investment setup right here. It's not going to be get rich quick, but I think this is going to be life-changing over the next 5 to 10 years.
Yeah, this is all kind of, let's say, adding evidence or weighted evidence to really showing this as a lower risk entry point, right, Christopher?
Very low risk. When you have something that's, again, something that cannot go to zero, mm-hmm. The sum of the Canadian Venture Exchange is not going to go to zero. And it's still trading at, what is that? You know, 25% of its previous all-time high. Mm-hmm. Same thing with the commodity complex. Yes, there's been a bounce off the lows. Okay, so there's been a doubling off the lows. But I would not be here talking about hard assets if we had this index up at 3,400. You know, when we get to that point, anywhere above 2,500 to 3,400, you know, the previous peak from 2011 to the peak from 2007, I'm going to have a different message, which is going to be, hey guys. And so the ironic thing is that at that point, we're going to have 5 times as many people listening to interviews like this. And you're going to have everyone wanting to buy at that point. And people are not going to like me at that point because I'm going to be saying, probably not the best time to buy up at the highs. We're nowhere near that point now. And there are sizable returns to be made if you do this properly and select good assets and good companies here, and you've got a few years ahead of you and you're not worried about, you know, the daily swings that these things can take.
Mm-hmm. So let's move on to your other chart here, because we can tie a lot of that in here, which is the XAU to S&P, and that's something else that just cannot go to zero, right? Yeah,
this just blows. I mean, this should blow everyone's mind out of the water if you're looking at this. If you're a contrarian investor, or you're getting tired of holding on to gold and some of these gold miners at this point, what we're looking at here is the ratio between the gold mining sector to the rest of the US economy. Again, a ratio that cannot go to zero. And functionally speaking, at what did we close at here? 0.037. I mean, functionally speaking, this is close to the lowest valuation that the gold miners have ever seen versus the rest of the US stock market, essentially. And so if you're independent minded here and you are, you know, and again, these types of topics, you don't have to be investing your the money for your rent or your mortgage next month. This is not to say spend your food money to speculate here in something you can't afford to do. But it is to say that if you're contrarian minded, if you're independent thinking, you look at where this ratio was valued at a previous. Now, the one thing about this ratio is we do not have data. This is the XAU index, which is a basket of about 25 gold mining companies. This index only started in 1984. This is the earliest that we have data going back. This is similar to the GDX fund. It's just, it goes back 2 decades prior. So if you're looking at this and you say this peaked out at about 0.87, but that was 1984. Gold had already fallen by about $400 off of its high. This ratio exceeded 1 at the 1980 peak in gold, which we know was a bubble. I mean, when gold reached $850 in 1980, it was a bubble. You can love precious metals all you want, but we had all the signs of a bubble in 1980. People standing outside the lines, outside the shops of coin dealerships waiting to buy gold, blah, 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 right? The point of this is to say, if you actually do an overlay, I've done this with there's a few gold stocks that actually go back to 1980. This ratio peaked at 1 to 1. And then you say, here we are at 0.03. There's not a whole lot of downside, relatively speaking, in the gold miners. And there's a heck of a lot of downside in the mainstream stock market, is what this implies. And furthermore, if this ratio goes back to anywhere in the region of its former peaks, you're talking about the average gold miner rising by something like 2,000 to 3,000%. This is the average gold miner. Or you're talking about the stock market falling by 96%. It's probably not going to be either one of those. It's probably going to be something like the average gold miner rising 1,000 to 2,000% and the stock market falling by 50%. One way or another, at this point, you're at an extremely, look, I'm not just pumping here. Look at the chart. This thing can't go to zero. This is the value of the gold mining complex. Lowest it's ever been. Have what you will with it. I think it makes sense to have a decent exposure at this point.
Yeah, that point kind of makes itself in a way.
Thank you for that.
All right. So then we have the XAU to gold ratio. Christopher, why don't you tell us why this ratio analysis is so powerful to you as well?
Yeah, just to emphasize the point again, ratios between real asset classes cannot go to zero. They cannot. So when you have something that is the closest to zero that it has ever been, yet it can't go all the way to zero, it's probably a pretty good bottoming spot, a good bottoming formation. And now here's the sort of quasi-ironic thing about what we're looking at now is that, even though we're talking about hard assets here, we talked about the CRB, I think most hard assets are going to do well over the next 5 to 10 years, perhaps even the next 2 decades. These cycles tend to play out. These are not 1 or 2 year cycles. These are like 1 to 2 decade long cycles that are ahead of us. So even though I think that's true across the commodity complex, and even though I think gold is going to do well itself, physical gold, the ironic thing here is that the ratio between gold miners to physical gold is also just rounding up off the lowest valuation that has ever been recorded in the history of gold mining that we have available data for. And again, so this starts in 1984. You see you see basically a 2.5 decade long range, a historical normal ratio here between the valuation of the average gold miner and the price of the very own product that they make. And then you see what happened in the crash of 2008, where capital froze for these mining projects. Exactly. And so what happened was the normal valuation, these companies that are mining for gold, what these companies are historically generally worth relative to their own product, got totally thrown out of whack in the crash of 2008. And then to make matters worse, you had an attempt at a recovery into 2011. Gold peaked in 2011. So the sector basically didn't even have a chance to recover. Gold then declined itself for another 5 years into that low, late 2015, early 2016. I chose to start publishing data. If you go back to the archives on goldeagle.com or my YouTube channel, you'll see that I started publishing in late 2015. It was for a reason. It was because I was watching this ratio. Again, I couldn't tell you if this ratio is going to keep going a little bit lower. It even did. I started publishing late 2015. You look at where that ratio went, right below that little red shaded circle in early 2016. Yep, the ratio made one new nominal low. And it's like, okay, so it went a little bit lower, but it did not go to zero. And Tom, if you could just zoom out for 1 second here. Perfect. The ratio did not go to zero. A lot of these gold miners rose 500% to 1,000% in that little surge that you see in 2016. And now we have the ratio of the gold miners versus gold itself that is getting ready to break out of an 8-year base. We call these stage 1 bases in technical analysis. This basically, it's an 8-year period where this ratio has been moving sideways after falling the closest to zero that it's ever been, moving sideways for 8 years. This thing is getting ready to break upward here at any moment. And when that happens, what I anticipate is going to occur is it's not going to happen in a vacuum. So it's going to be something like where the price of gold, let's say, goes from 1,800 back to 2,000, or maybe even above, the former peak. Maybe price of gold is moving its way into the 2,000s. Let's say, 2,100, 2,500 over the course of the next year or two, which is going to be a nice gain for gold. Don't get me wrong. But when this ratio breaks out, it's showing you that a lot of these gold mining companies are going to see gains that are just orders of magnitude above the price of gold itself. So you combine that with the chart we just looked at, the XAU to S&P 500. I think if I can just be really direct, I think this is the time to be overweight the gold and silver mining sector. That will not be the case about 3 years from now when this ratio has reverted to the mean. If you're listening to this now, this is a time to have a healthy allocation, as long as you're being prudent with your money management. This is the other big thing. We hinted on this a few minutes ago. I think the place where a lot of investors get into trouble is they see data like this and then they say, I'm putting every cent, not only every cent, I'm using my credit cards. I'm going to go in on, I'm going to buy with mortgage payments that are set aside for the next month and hope to double my money in the next month. And then, what happens? It's like, shit, it didn't work out in a 1 month time frame. That's when people get into trouble. Don't do that. Use the money that you can afford to use in a good way, which you're looking at it right now.
When you were saying, what happens, Christopher, it reminds me of today. Of course, we're speaking on the afternoon of Wednesday, May 12th. We had some, impressive, from a negative standpoint, inflation data come out. One would have thought that gold would have reacted positively to that, and nearly everything sold off today. So exactly to your point, and Lawrence Lepard recently pointed this out on the show as well. Don't use leverage if you want to do this safely, even if your conviction is 100%, things can still go against you, right?
Exactly right. So prudent money management is so key. And Tom, today's price action is it's not only laughable. It's sort of a perverse little market cycle that we're in here, where basically what's happening is when you have high inflation figures that are coming out in the news. This is not just today, but it's basically over the last couple of months, the market has been preoccupied in this way. When you have strong inflation figures coming out, you have the opposite reaction happening across all the markets, which is for inflation sensitive assets to sell off on strong inflation figures. Here's the reason why this is happening. And remember, it doesn't have to make sense. I think investors need to banish from their minds that things need to make sense over any real world usable time frame. It's just, if you want things to make sense, you're going to get yourself into a really frustrated place. This is why I like to focus on the charts, because it doesn't have to make sense. The charts are more like it is what it is, and you learn to become a little bit agnostic with the perceived fundamentals. Because right now you have noise. Markets. Sorry.
And you become agnostic to the daily noise as well.
Totally right. So, what was it today? So you have anytime the inflation figures are high, you have gold and silver selling off, because the rationale in the market right now is inflation is high. Therefore, the Fed is going to raise rates soon. Therefore, inflation will be low. So high inflation is low inflation right now. And for that matter, anytime you see any sign of low inflation, it's taken to mean high inflation, because that means the Fed is not going to act. So, it's where we are. Accept it, love it, live it, and we have to do the best we can. It won't go on forever. These correlations, if you've been around, I know, Tom, you've been here for at least a cycle and a half, similar to myself. You've seen these correlations come and go before. These correlations, they last for a few months, sometimes even a year or so, and then they just break. And it's not going to be any different from this, but it'll happen without warning. And so the people who get accustomed to, oh no, there was high inflation, therefore sell your gold, it's going to change on a dime.
Yeah, I think that was an excellent explanation and rationalization to today's market action, and helps give our listeners, a way to conceptualize what happened today and maybe why it's happening that way.
Yeah, it's really it's quite messed up, if you ask me. But again, it is what it is. It is what the market is saying over the short run. And so, there could be a little bit more of this.
Mm-hmm. Excellent, Christopher. Do you have anything else you'd like to leave our audience with before we wrap up here?
Yeah, I just, first of all, thanks for having me on the show. It's been great to speak with you and the entire audience here. And I just want to encourage people, once again, if you've arrived at this point, you're here, you're listening to this interview. Not only that, you're listening to the end of this interview. Keep your open-mindedness, your independent thinking cap on, not just for economics and finances, keep it on for other realms of life as well. Because I think when we see everything that's happening in the world today, it's just so critical to be able to think for yourself and not necessarily accept, look, it's not to say you reject everything that the mainstream is telling you. We all have to be citizens of this planet together. But I think it's just very important to think independently about what is occurring here in the world around us now more than ever.
Yeah, and not necessarily reject it all, but look at it with a bit more of an analytical mind, right?
Yeah, exactly right.
So, Christopher, you're available on Twitter at iGlobalGold, and of course, iGoldAdvisor.com and gold-eagle.com, right?
That's correct, Tom. Yep. Thanks for giving all that up.
Excellent, Christopher. Thanks so much for your time today.
Thank you for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.